Hello, everyone. Thank you very much for joining us today. My name is Corey Daharsh with Advanta IRA, and I am here to bring you a presentation on private lending through an asset manager with special guests today, Nathan Larsen and Josh Bennett. So again, I'm Corey Daharsh. I've been with Advanta IRA for about 6 years now, both serving as a client account manager, handling your day-to-day transactions and questions about your retirement account, and then also switching over to the business development side about 2 years ago, where I now work in education, networking, and bringing in new clients to self-direct their retirement funds. My guests today, again, are Nathan Larsen and Josh Bennett, both of the Mid-Atlantic Advisory Group. Nathan is the Chief Investment Officer. I've been networking with Nathan and working with him thoroughly for the better part of this year. And Josh, I've just met recently, but looks like we're going to do some work together. And I look forward to this presentation today. And thank you both for joining me. Is there anything you would like to say about kind of your background respectively, or anything as we get started with the webinar today?
No, thank you so much for having us. And I think this will be very helpful for a lot of people. So thank you again.
Of course. And just as we get started, for everyone participating today, I am going to cover a brief explanation of self-directed retirement investing and how it relates to note investing. And then I'm going to turn over to Nate and Josh for their portion of the presentation, which is actually the asset manager portion of the presentation. As we're going today, please get familiar with the GoToWebinar panel that you all should have on your screen. You can go ahead and drop any questions into the question box. We will answer them as we go. There is also a point at the end of the webinar with an actual Q&A dedicated slide, but please don't hesitate. If you have a question as we're speaking, please feel free to drop it in the question box and we will articulate those and answer those accordingly as we go. I'll also mention that the slide deck can be prepared and provided to you at request. So take down our contact information from this slide you're looking at now. You can reach out to any of us and request a PDF version of this slide deck, or you could also rewatch the recording on Advanta IRA's YouTube channel at any time you want to in the future. So again, just a little bit about Advanta IRA. We've been in business for over 20 years, just about 20 years actually, and we have just over $2 billion in assets under management. All of the funds our clients hold in accounts through Advanta are insured up to FDIC limits when they're uninvested. And another thing that we do to stand above and beyond other competitors in the self-directed investment account space is that we pair each client with a dedicated client account manager. That role I mentioned I used to serve, where you're just dealing with a person on onboarding side, myself, and then a person on the actual account management side for the life of your account moving forward. So you don't have to worry about a large wire center where you're calling and having to explain your situation and your investment goals to a new person every time. You get familiar with your rep and you work through any questions or any transactions with them on a regular basis as you use your investing account. Now, a brief disclaimer before we get too far into any major details on this slide deck. We at Advanta do not provide any tax, legal, or financial advice. We don't endorse any specific product or opportunity. All of the education that you'll see today, or all the materials you'll see today, are for educational purposes only, and we do implore you to always consult your own legal, tax, and financial professionals before engaging into any investment that you may be interested in pursuing. So some of the key takeaway points I'd like everyone to walk away from this webinar with is that private lending opportunities are much broader than many people anticipate. Some people think private lending and they just say, oh, I can lend to my cousin, or I can lend to the neighbor down the street that's trying to get a new business off the ground. There are many, many different options and variations of private lending that you can take advantage of. When you're taking advantage of those with your retirement account, all earnings are generated by your retirement account in either a tax deferred or a tax-free basis or status, meaning you do not have to pay taxes on that income you generate now until you distribute it later in life. from a tax deferred account, or if you're making these investments with a Roth or a tax-free account, all of the earnings you're generating are growing and being made completely tax-free, and you'll never have to pay taxes on them in the future. And the third key takeaway point is that lending via a note fund or a loan servicer can create favorable returns with less direct responsibilities than you directly lending to a borrower and having more of the overhead rules and responsibilities on your plate for that. And really, that note fund and loan servicer portion is why we've got Nate and Josh here today to talk about that. That's their level of expertise, and that's why I've brought them on to speak about that portion of the note investing strategies. So what is a self-directed IRA? Basically, it's an account that allows you to invest into any asset that you'd like to within a few simple rules and regulations without restricting you via a financial decision or a fiduciary responsibility to say, oh, you should invest into this, you should invest into that. Advanta IRA simply follows the IRS's rules and regulations and allows you to pick exactly what you want to invest into and how you want to utilize your retirement dollars. If you're not familiar with that, it's pretty common that people don't know that self-directed investing exists. To be truthful, only about 4% of retirement accounts in the US are self-directed. And to put that into perspective, in the first quarter of this calendar year, 2022, there were $37 trillion in US-based retirement accounts, which is actually down from a year ago right now, quarter four of 2021, when it was $39 trillion. So of those trillions and trillions of dollars, only about 4% of that money are taking advantage and utilizing self-directed investment strategies. So in Advanta IRA, we put out a lot of free education. We do a lot of networking just to spread awareness that this even exists and allow the clients and investors to pick their investments and make use of their money as they see fit from there. Now, there are plenty of different types of plans that can be self-directed. A lot of people are familiar with the traditional and Roth IRA, but there's also small business plans like a simple or a SEP IRA and a solo 401k that you can self-direct, as well as health and education savings accounts that can either cover yourself individually or your family in a health savings plan, or an education savings account for your children as they build up retirement dollars or savings dollars for their future or current education expenses. Now, I've just got a few final slides here, and I want to convey to you why people choose to self-direct. So you may be in any of these buckets, but a lot of people choose to start self-directing because they find it as a new source of capital. They hear this webinar, they meet with us in person, they learn, hey, I'm already doing this type of investments and I'm making great returns on it. Now I know that I can tap into my retirement money to do the same thing with, and that is a big driving force of bringing people to self-directed accounts. Another thing is the stock market fatigue. So really just being tired of stocks, bonds, and mutual funds and the fluctuation that the market is having right now. And the tax benefit, again, as I referenced a few slides ago, making your investments and letting your earnings grow either completely tax-free or on a tax-deferred basis, so you're only paying taxes later on in life and you're not subject to capital gains or other types of taxes that would apply when you're doing the same type of investments with your personal money out of your savings. Now, the rules for self-directed investing are very simple. The only asset classes you cannot invest into are life insurance policies or hard to value collectibles like antiques, fine wine, artwork, anything the IRS would deem to be subjective in value. But if it's not of those asset classes, you can invest into it. And the only other restriction that the IRS holds is disqualified persons, meaning yourself, your spouse, your parents, and your children are not allowed to sit on the other side of a table from you in a deal or in a transaction. So for example, regarding lending, you cannot loan money to your parents, or you cannot borrow money from your parents, or vice versa with your children, or even yourself or your spouse. So as long as you're able to follow those simple rules and find other borrowers or utilize a note fund or an asset manager for lending, you can do a lot of different lending investments through your retirement account. So I'm going to cover some very simple basics on lending, and then I'm just going to wrap up my portion in the next 2 slides. When you're looking into lending, a retirement account is allowed to lend to a borrower and choose with that respect if they want to do a secured or an unsecured loan. Secured meaning some piece of instrument is being recorded in the county of question as something that you can collect on if the borrower defaults on the loan, or an unsecured loan is basically just a promissory note, and if the borrower defaults, you may have little to no recourse at that point in time. In addition to vetting the borrowers yourself, you as the account holder are responsible for negotiating the interest rate, any collateral, the down payment, if anything is applicable, and the repayment window as the account holder and lender on the note. You may set a maturity date 2 years out and realize that your borrower is not going to pay by that date, and you can actually amend or modify the note as well. You have complete control as the account holder to utilize as you see fit and adjust the rules of the note or the documents securing the note as you go. The next thing here is that you're not allowed to lend to disqualified persons, and some forms of collateral may be disallowed. So for example, if you're lending to someone and the only collateral they have to put up is maybe a vehicle, well, you can't hold a vehicle in a retirement account. So there may be a situation where you have to take in the vehicle as collateral and immediately sell it to satisfy and not break any IRS rules or regulations. Something like that is a conversation you'd have with your client account manager at Advanta and also your other professionals involved to decide what your best course of action and interest is in handling a situation with a unique form of collateral. And the final point here on my lending basics is that states are going to have different rules for private lending in a self-directed account. You're going to want to consult the appropriate counsel when you're deciding to invest into lending opportunities. So check within your state, check with your Advanta representative if we have any insight for you from the client account manager role, and you should be good to go conducting thorough and clear due diligence in your investment strategies. Now, as I'm wrapping up, I just want to let everyone know Advanta IRA, as I said earlier, provides a lot of free educational opportunities. If we're in your area, which would be the Tampa area, the Atlanta area, or myself in Western North Carolina, we may be putting on an in-person event near you, a lunch and learn or some other type of seminar or in-person event. So check us out there. We also have an in-depth and very robust video library, which this video will be added to after the recording is completed. So go check us out on YouTube, where you can find all of our educational webinars. We also have a podcast, the Alternative Investing Advantage podcast. You can find anywhere that your podcasts are broadcast. And we have a blog if you're interested in industry news, kind of a little bit more of the nerdy tech side of the retirement investment industry. But if you are interested in that, you can check out our blog as well. We are very simple to get a client set up and started. It takes most people about 7 to 10 days to get their account open, funded, and ready for its first investment. It only takes about 15 minutes to complete an application. You're then paired with a client account manager that helps you on every step of your investment goal and journey. And funding the account's very easy too. You can either make a new money contribution or move money from an existing plan, whether it's a previous employer plan or an IRA with another custodian, to start self-directing. Now, with that being said, I'm going to turn it over to Nathan for the larger part of the presentation today. Before I turn it over officially, I do want to remind everyone that the question box on your GoToWebinar tab should be open, and you can go ahead and drop any questions you may have as Nathan's presenting with Josh, or at the end there is a Q&A slide as well. So we will also just stop, break at the very end before we sign off and allow you to add any final questions you may have. So with that, I'm going to turn it over to Nathan on this first slide of the Mid-Atlantic presentation.
Thank you so much, Corey. And just to reiterate that, We designed the presentation having done many of these in the past, knowing that there are a lot of questions. And so we'll go through a lot of this information quickly based on the assumption that there are going to be questions along the way. So please chime in at any time. So a little bit about Mid-Atlantic and our sister company, Credo Capital. The easiest way to describe and explain what we do is we are a connection point. We're designed to connect individuals that would like to invest money safely with individuals that have products or business ideas. We are a guidepost. The borrowers that we deal with come to us to access capital for their projects and business ideas and properties. And we connect them with the right investors that have the right risk appetite for a particular project. And we will be a full service facilitator of that process, both the origination of that note, the servicing of the note, and the completion and release of the note. We've done thousands of these full cycle debt transactions, and it's exactly our niche. And I've assembled a team of 5 people that have done this their entire career. Serving as the chief investment officer, my background is for years was with Wells Fargo in managing debt portfolios for Wells Fargo, evaluating the risk, assembling servicing teams, and monetizing those receivables throughout the process. Josh serves as our director of finance. And Josh, if you want to give a little 30-second background, be my guest.
Sure. Hey, yeah, Corey, thank you so much for having us. Yeah, my name is Josh. I have been working with Nathan for a little over a year now, working on getting everything squared away, payments out to our investors. My background is corporate finance. I've been in accounting and finance, various roles for Fortune 500 companies, to tech companies, to a few startups, and just love what I do, and excited about this investment vehicle, and getting to learn more about it, and to share with y'all a little bit more about it.
Okay, so this is just an overview of kind of the basics that we're going to tackle today, and a good outline for where we're headed here. So in addition to what Mid-Atlantic does, we want to design a company and design an investment vehicle that meets today's needs. We have been doing this full-time since 2010. The business model was designed coming out of the Great Recession to be a recession-proof safe haven with secured real estate backed assets. And the model has changed a bit over the years and is a very flexible model. We can change quickly based on our note terms. But today's world looks a lot different than what a lot of us were used to investing in the past. And it's been changing fast. A lot of us are sort of left scrambling to figure out what the future of investing looks like, what the future of the stock market looks like, how to best allocate assets within an IRA as you approach or in retirement. And so we've spent a lot of time designing the current product and the current offering of our services around ways to eliminate volatility in your portfolio, but also create an environment where you can have stable returns that are consistently outpacing inflation. And so that's really the focus of today. So why this asset class and why now? There's a few things that this specific asset class solves for. Like we mentioned, Corey and I both mentioned, it's a vehicle to eliminate volatility in your portfolio. One of the unique aspects of this product is that it has a fixed return to you. You're going to earn a return based on the note to your borrower. So if that note is at 5%, 10%, or 15%, that's the designated return. What's also unique about that, that's different than many other fixed asset classes, such as a tradable bond or other fixed assets, is that not only is the return fixed, but the value is fixed. So if you invest $500,000 in several notes, they're worth $500,000 when you invest, they're worth $500,000 a year from now, and they're worth $500,000 at maturity. So you're not only fixing your return, but you're fixing your principal investment as well. And that's what makes this very unique. Now, nothing is too good to be true. And so one of the downfalls to this product as it relates to individual investors is that although it's flexible, it's not a completely passive return. It's not set it and forget it like you would a dividend or a distribution on another type of investment. So that's where we come in. That's where many investors that want to seek those positive outcomes need a little assistance from an asset manager along the way. We've designed a product that has absolutely no fees. It's the first that I'm aware of in the industry where there's no fees at all to the investor. And the way that works is simply that the borrowers that need money for their businesses, they compensate us to connect them with the right investors. And so that money is taken care of by the folks that come to us needing to raise capital. That way there's no fees whatsoever to the investors. Okay. So let's dive into a little bit about note lending and what the basics are and how that really works and what some of those best practices are. So Neil Ferguson, professor at Harvard, explained lending as the process of transferring idle money into the hands of the industrious. So at its core, that's what banking is. Money that's sitting on the sidelines that is put to good use to improve things in our community and in society and make a profit along the way. So why does this exist, right? Many people look at this and say, well, it's too good to be true. If I could make returns like this, well, why aren't the banks doing it? And do we have to take a lot of risks to do that? Well, no is the answer. You don't have to take a lot of risk. And it exists because there are many gaps today in the banking industry, and there's many banking product gaps, much of which was created in the Dodd-Frank Act of 2010. And so that gave banks massive limitations on how they can allocate the lending that they do to different businesses, to different property types, to different geographic locations, different risk categories. So what this product allows you to do is essentially become the bank. And we exploit gaps in the products that banks offer. And it forces really good, high quality borrowers to come to companies like ours to look for solutions to those gaps. And a lot of banking products are prohibited. Banks do not want to do a couple one-off loans. A large bank is going to want to put $1 billion to work in a very defined asset class and surround it with a management team. And if they can't do it, it's just not worth it to them. So there's many holes that we have opportunities to fill. So how does private lending differ? So one of the things that we are used to sort of in our society is government subsidized rates and government subsidized lending. Somewhere around 85% of home loans today are backed either in full or in part by the US government through Fannie Mae, FHA, the VA. They're called conforming loans. They conform to those guidelines. And as we know, as we've all seen with the Federal Reserve lately, they can dictate what those rates are. And the reason that we can get higher rates in the private lending world is because it's based on the natural appetite of the market for risk. And we can base our pricing and our interest rates and our fees that we charge based on that appetite and based on that risk. The other reason that we can get higher rates is because we exploit the gaps in the banking products. And we offer very short-term loans. Risk is associated with time. So as things change in a family, in an economy, in a business, or politically, they incur changes in the likelihood of a loan getting repaid. So we're able to evaluate risk in a short term, but it's very difficult to evaluate risk in a long term. In other words, we know what a community or a business or a family is going to look like a year or two from now, but knowing what that is going to look like in 15 years from now is nearly impossible. So we avoid a lot of risk by doing short-term balloon loans that mature between 9 and 18 months typically. Interest rates that we charge are higher than banks, but they're not higher than banks because we're inherently doing more risky loans. We're charging more because we provide a better service. We can close on loans quickly. We can offer flexibility in our loan types, and that's of value. The borrowers that we have look at it is the same way of buying a first-class airline ticket. You're getting to the same place, it's just a more comfortable ride. Next. So what is note lending and what is it not? It can be done inside or outside of an IRA. It just depends on the changes in the taxation of it. It's a way to create stability in your portfolio. It's not to be used as a speculative portion of your portfolio. This is not a product that's going to go up and down like Bitcoin. It's not going to be $50,000 tomorrow and zero the next week. It's designed for the fixed asset, fixed return portion of your portfolio. It's a low risk investment typically, and that works well for most people as they approach or get into retirement. One of the biggest barriers that we find as we work with people is they become comfortable around the asset class and the idea of doing this, but they don't know where to get started and they don't know where to find their borrowers from. And that's where we come in. We have a portfolio of hundreds of different borrowers that we've worked with over the course of the last decade, and we can help people find them. But typically where a lender is going to find a non-bank-based borrower with a non-bank-based product is just in their natural environment. Friends and family, friends at banks, loan officers at a bank that may kick somebody your way, friends of yours that are growing local businesses, real estate investment clubs or community-based investment clubs can come up with ideas and present, those borrowers can present to those clubs and get loans. And local builders and real estate agents. Many of our friends and neighbors build houses or are contractors, and those are all opportunities that we should be looking at, to help them with their businesses. So what are some of the best practices to mitigate risk? Our primary goal is to create a very stable product with returns that you can rely on. The toughest thing about lending is determining intent. We have found that the loans that are likely to be paid perfectly and are the lowest risk are the people that value the money the most and have the full intention of paying you or us back. The problem is intent is almost impossible to gauge. And so we break down our lending decisions and our evaluation of risk into four categories that we call the 4Cs of lending. And those are credit, collateral, capacity, and character. We all know what credit is. It's a historical story that we tell that's tracked by various agencies of our track record in paying other creditors back. Collateral is simply what's backing up the loan, what's the security, and how valuable is it? That's a valuation of risk, super important. Capacity is the way we think of a borrower's ability. So this is their ability to pay. How much money do they have coming in or in reserve that would ensure timely payment to us? And the most important one, but also the most difficult one, is someone's character. Again, we have found that the right people with the right intentions make good decisions. And so we evaluate each of these four categories with every person that we get involved with. So risk and return. As investors, we are very focused on where do the line between risk and return meet? If you're willing to take on more risk over time, theoretically, you should get more return. And that's typically a pretty evenly based proposition in most investments. Lending is a bit different. What we have found is that because interest rates can only be so much and so high, and they eventually will hit regulatory boundaries, it's almost impossible to charge enough or to get enough return for a highly risky loan. You may take on twice the amount of risk for a 10 or 20% return. So we have found over the years that safe loans with good collateral to highly vetted individuals is the best, most consistent way to get good returns in a portfolio. Taking on excessive risk or excessive complexity in your loans leads to problems almost every time. Okay. So where is the sweet spot for loans? What are the returns going to look like, and how do you best get there? Bigger is better. And what we mean by that is larger loans. Small loans can be extremely cumbersome and costly, but people tend to do them because you can do many of them and you can diversify your money over multiple borrowers, multiple properties, multiple loan types or geographic footprints. But the problem is that small loans have the problem of what economists call the big problem of small change. And that means that there's a lot to do. It's costs you in money and time the same amount to service and initiate a $1,000 loan as it would a $100,000 loan. So in order to become diversified in that portfolio, it's going to cost you a lot of operational money per dollar lent if you're doing smaller loans. The problem is if you want to be diversified in multiple loans and keep your time and your OPEX low per dollar lent, you got to do really big loans. And that's where a loan servicer, an asset manager, or a fund comes in. It allows you the ability to diversify across multiple loans without having to lend millions and millions of dollars. And the sweet spot for returns, if someone's doing this on their own in the market as a whole, the secured real estate business traditionally is going to be in the 7 to 14% interest rates. And that's not necessarily perfect for today or any specific geographic market or loan type. It's just what we've seen over the last couple decades in terms of common charges that lenders like us and in the secured lending market would charge. And if it's not secured by real estate, it's typically considered a little bit more risky, and typically the rates are going to be in the 12 to 18%.
And Nathan, I've got two different questions that came in on this slide. The first one just states, what rate do investors get? I think that's more so a question that that person would want to connect with you offline on. Am I not mistaken to that effect?
Yeah, I can give you some generalization, but absolutely love to connect on that offline to give more specific detail, because a lot of it does depend on the appetite for risk, geographic specifics, amount invested. But typically the investors with us are going to get in the range of 8 to 12%, depending on the types of loans, the amount invested, their appetite for risk.
Perfect. And the other question, you used an acronym or a industry term. I don't think it was CapEx, but someone just said, what was that term?
OpEx.
OpEx, yes.
OpEx. It's an industry term for operational expenses. And
Perfect.
so one of the measures of profitability in lending is how much of your interest, if you're charging 10 or 12%, how much of that is eaten up in costs, and how much of it is eaten up in your own personal time. So the example that I commonly give is, if you're doing $1,000 loan at 10%, that's the return you're going to get, no more, no less. And you have to generate loan documents and collect the payments and monitor your collateral and all the things that go along with it that we're going to actually jump into in one of the next slides here. But all those same things with all that same time commitment would happen in a $100,000 loan, except that your money you're collecting is 100 times as much. And that's the comparison we commonly use. Hopefully that explains that. Mm-hmm.
Yeah, no, that was a great explanation. And just as a quick reminder before I mute myself again, please keep the questions coming. I know Nate has prepared his time to answer these as we go. So please feel free to ask questions in the question box as you have them, and I will address them as I just did here. I will mute myself and flip to the next slide, turn it back over to you. Thank you.
Sure, thanks. And I think we're finished with that slide. So the next thing, which we just talked about that we're going to jump into, is what all is involved in note lending. It's a great asset class, and everybody sort of agrees on that if it's done correctly. But it's not as passive as most think. And so in the next slide, we'll look at some of the items that a private lender needs to be involved with over the course of a loan. So I'm not going to go through all of these, but as you can see, you've got to find your borrower first, then you've got to assess your risk, assess your collateral, and you have to agree on terms with them. You then need to have really good vetted loan documents that are specific for your type of loan, your type of collateral, the state in which you're doing business in. And then you've got to have someone to close that. How do you explain them correctly? How do you go through them correctly? How do you get them recorded? What do you do with all that information once you have it? How do you calculate interest every single day? How do you calculate partial interest? How do you keep those records? Are you going to be able to send them tax documents at the end of the year if they want to deduct that interest as a business expense? There can be an overwhelming amount to do. And unless you got the amount of assets needed to really create a business around this, doing this one loan or two loans at a time on your own can sort of mitigate most of the benefits of doing it. But these are all of the day-to-day, year-by-year services that an asset manager or a fund would handle on your behalf as the lender. So let's dive into that a little bit more. So the next three slides, we're going to go over really what differentiates on a day-to-day and sort of cash movement basis, the difference between lending, private lending on your own, private lending with a loan servicer, and private lending through a fund, and what the pros and cons are of doing that. So this is an example of what it would look like doing it on your own. The first thing to understand is that your lender, as an IRA account holder, the lender is going to be your IRA account, not you as an individual. So your IRA will actually lend money directly to a borrower or project, property, or whatever type of loan you decide to do. And then that property, project, and borrower will then make payments back to your IRA account. However, your IRA account, being a separate entity, is not going to be able to service that loan. They're not going to be able to send statements on your behalf. Corey's not going to do that for you. So that, as an individual owner of the IRA, would be your responsibility. You would work with the borrower, communicate with them, conduct a closing. You need to send them statements, answer questions and problems, figure out how to deal with loan extensions and tax questions. But all of that would be done with no intermediary. The benefit to that is you operate the way you want to operate, and there's no intermediary. You can charge whatever you want to charge, but the risks are all on you. There's no intermediary to help you when you get in a bind and be any kind of risk buffer for you. Okay, let's go to the next slide. So this is an example of what it would look like if you dealt with a loan servicer. So if you want to be the direct lender, or your IRA account becomes a direct lender, you can hire, paid for by the borrower, a loan servicer or a loan manager. So they will help you initiate the loan, execute the documentation, record your security. They will send statements for you, collect payments for you, and forward that interest onto you each month. When the loan approaches maturity, they will not only manage the construction project, but manage the end of that project, quoting the payoffs, managing the timing of it, conducting that closing with the attorney or whoever's closing out and paying you off, if it's real estate agents or title companies. That can all be done as an intermediary. Now, your IRA account is still the lender. Any losses are going to be incurred by you and your IRA account, but the loan servicer would help and facilitate any of that process. They would give you good advice along the way and help to mitigate any losses. Corey talked a little bit about the problems that can come up with owning a property like an automobile or collectibles and different things in your IRA account. And the short answer there is you really don't want to do that. And so a loan servicer can help avoid those scenarios.
And just to add in and chime in with Nathan on this slide, as he mentioned on the last slide, Advanta IRA does not serve as a loan servicer. So the last slide really covers the responsibilities on a retirement account holder if they wanted to do this type of lending themselves. This covers what would be the case scenario using a loan servicer. And exactly as Nathan said, they'll help you avoid some of those conflicts and some of those mishaps that may come about in a investment transaction or in a loan, so that that's not on your plate as the account holder, leading you more towards a truly passive strategy as opposed to an active basis of a passive strategy. I just wanted to add that for what it's worth.
Thank you. And just a couple last points on this particular slide and the way this works. It's important to note that the IRA is the lender of record in a scenario like this. The benefits that, like Corey said, is that you push yourself very close to a passive income scenario. However, you still have single note risk in a property. If you've lent $200,000 or $300,000 into one property, your entire return is dependent on the performance of that loan and that property. Now, the likelihood of default can be very, very low, but you have single property risk, you have single lender risk, and you have one lender attached to one borrower secured by one property. And that's the easiest thing to remember about this servicer scenario.
And another question just came up before we move
Yeah.
on to the note fund opportunity. What is the process when a loan is delinquent? I guess that's more so the question as a loan servicer. I don't know if you need to get into your exact protocol, but can you just kind of describe from a retirement investor standpoint, will they even
Yeah.
know that the loan's delinquent or kind of just take it from there?
Yeah, it's a great question. So in this scenario with a loan servicer, they would know. We have very, very few delinquencies, but when it does happen, we will talk to the IRA owner and say, this is the scenario that's going on. This is what's going to happen. We suggest you do A, B, or C, but we work for you, so you tell us how you'd like to proceed. We vet each of these loans very carefully, and one of the things that we look at is multiple exit strategies. So delinquency doesn't really ever become severe in the loans that we structure because the end point of the loan approaches very quickly. Many of our investors will actually pay months and months worth of interest in advance. So we already have the money to distribute to the investor at the time of the loan closing. Sometimes we require that. So delinquencies do not come up a lot, but one thing to remember about this is the IRA and the IRA owner are the lender. The loan servicer is facilitating those payments, making sure that you get them on a timely basis if at all possible. But if they don't pay, you don't receive a distribution until the time at which they pay. So your distributions are based on the amount and the timing of the payments you get from the borrower that we've jointly chosen. So you are attached to that.
All right. Thank you very much, Nathan. One final question. I think this is more so a question for me to answer. Your investment in this remains in the IRA and is recharacterized as an asset class of loan. Just to clarify on that, yes. So if you were to make an investment into a loan, and whether you're utilizing the loan servicer or not, the asset class on your record with your retirement custodian, Advanta in this example, is going to be either an unsecured or a secured loan, depending on that collateral being in place or not. So that really is the classification. It does stay as an investment, as Nathan mentioned, owned and in the name of the retirement account, and it'll just show on our records as either a secured or an unsecured loan held within your IRA or 401k, whatever account that may be. And we'll move on to the next slide unless you had any final tidbits on this one, Nathan.
Nope, I'm finished. Thank you.
Yep.
So the final way to look at doing this lending in your IRA portfolio is through an investment fund. So the big difference is that we would collect multiple investors, pool the money, and then make multiple loans with that pool of money. Your benefit there is that your return in your IRA account is not dependent on the performance of any given loan, and your distributions and income are not time dependent based on when those borrowers pay. So the easiest way to look at it would be in the last scenario that we looked at, if you lent $200,000 to one person and one property, you own 100% of one $200,000 loan. In this scenario, if you lent $200,000 as the lender, you may own a 10% interest in 20 loans instead of 100% interest in one loan. And so it creates diversification in your portfolio without the need to do high risk, low dollar amount loans. So you create that second intermediary as well. So if you're lending directly yourself to a project or a borrower, you're dependent on that individual performing. In this scenario, you have the borrowers who have committed and personally guaranteed those loans, and you have the commitment of the investment fund and the insulation that they provide, because they're gaining revenue on every loan that they do, and the investment fund would create provisionary self-insured funds against losses that would then cushion any small losses the fund may have on the loans that they invest in. That way it eliminates the direct connection between one property or one person with the performance of the IRA account, and sort of smooths out the bumps. The investor in the IRA gets paid by the investment fund regardless of the timing and amount of the payment from the borrower. You commit to a certain timeline instead of a loan, the timeline tied to a specific loan. When you lend us an individual directly or through a loan servicer, the timing of your loan, the timing of the principal investment that comes back to you is reliant upon the payoff of that one loan. In this scenario, you determine your timeline. So that could be anywhere from 2 to 5 years typically. You can get investment money back in as little as 90 days if you needed it, but you have the ability to determine your endpoint versus tying it directly to one borrower or one project. This eliminates the single property risk that we talked about. That is probably the biggest fear of most private lenders. How do you eliminate one property or project dictating the return of your fund or of your retirement fund? So this is a really good way to do that. Probably a lot of questions. I think we can.
There are questions. You actually answered the most
good.
recent one, and she posted answered. So that was great. The question in itself was, what is the typical time frame of the fund loan? So you clearly got to that one.
Yeah.
Here's another one. Is your IRA recorded in the public records for the manager and the fund?
So
yeah,
that's a great question. So I think what the question is let me make sure I answer that, and you can tell me if I'm answering it wrong. But in terms of recording, yes and no, and let me tell you the differences. So if you are the lender of record and you're lending on your own or through an asset manager or loan servicer, your IRA account will be a recorded lender of record. In a fund scenario, you would lend actually to the fund itself, and you would have a note with the fund guaranteed by the fund and recorded. The fund would then in turn lend to the borrower and would be the lender of record on the specific property.
that is exactly how I would have outlined the scenario, just in my understanding of these types of investment strategies. So I
Right.
think that makes clear and perfect sense. You are the lender on record to one specific transaction, and then the funds that you're lending on are used for an additional transaction of which you're not the lender of record on.
Correct.
Okay, perfect. Another question here that may, at your discretion, be taken offline. Normally, what is the asset value of the fund?
So the total asset value of the fund, is that the question?
I believe so. My interpretation would be that.
Yeah.
The question is worded exactly. Normally, what is the assets value of the fund?
Great. So it does vary based on our open loans, and as we have loan opportunities and we decide to raise more money and open it up to more investments. So typically that's going to be anywhere from about 15 to 40 million.
Okay.
In terms of the fund asset value, yeah.
Perfect. The next question here, this is a question for me directly. Is there a fee from Advanta for investing in this product? So any investment transaction that a client does within their Advanta account, there are applicable fees, typically a transactional expense. We do have a fee agreement that allows our clients to choose between 2 different options. If you want to learn more about that or actually get that fee agreement document from me, just email me offline and I'll be happy to share that with you. It's not something, again, webinar is going to be posted on our YouTube channel, so it will be dated. So whenever you're hearing this and seeing this, reach out to us directly for any offline type questions that we can't answer in a definitive dated path. Next question here: does the fund manager charge the investor a fee? Are there regular scheduled disbursements to the investor? And follow up from the same person, is there a minimum investment? If you want to kind of answer those in hand.
Right. So we do not, the fund, Mid-Atlantic, does not charge a fee to the investor. There are regular distributions. Typically, investors that are investing outside of an IRA get monthly distributions. So typically what will happen is Josh will go in on the 5th of every month and distribute all the interest distributions to all of the borrowers or all of our investors. And in terms of minimum investments, the smallest investment we have currently is $100,000. We do have a sample $50,000 investment to sort of try it before you buy it, so to speak. And we haven't had anybody take us up on that, but that is available as well.
Perfect. Thank you very much, Nathan. Next question here: is the fund loan considered collateralized? If so, what is the collateral?
Yeah, so it is collateralized, and it's actually collateralized by the receivables in the portfolio. So the fund would make loans to on properties secured by real assets, and those assets and properties, the secured properties, are documented in the note that we sign with investors. So your investment in the fund itself is secured by the portfolio of collateral.
Perfect. And I think your answer there inherently answers this next question. So it would be secured indirectly through fund, not directly, since we are not recorded, correct? Comma, correct, question mark. So
yeah, so we really have two opportunities there, depending on whatever the interest of the investor would be. So if that is something that's important to them, right, having their name or their IRA's name directly associated with that loan and recorded as such, that's important to someone, then that's a good avenue to choose loan servicing or asset management, right, where you become the direct lender of record, and that's recorded. And you're in control of that, and we act as your advocate in that process. So that's absolutely a way that many people have chosen to do this. Bear in mind that that typical minimum investment is going to be larger, and that works really well for people that are very knowledgeable about real estate, knowledgeable about lending, have been involved in this in the past. It's a really great product for that. If the timeline in terms of start to finish of your loan, your time commitment is important to you, knowing that, if you want to possibly invest a little less than one loan, and typically one loan for us is, our average loan is about $300,000. So if you wanted to invest in one property through an asset manager, just handling loan servicing and having it recorded, it's a great opportunity. But just bear in mind that those are pretty large single property investments, because those aren't going to be split up. And so the best way to do that is either a lower dollar amount, or if you want it completely passive, is to do it through the fund.
all right, perfect. Well, we are right at 1 o'clock Eastern, right at the 1 hour mark on this recording. I'm going to go ahead and flip here to the final slide, which is a repeat slide displaying all of our contact information. The number on the slide here for Nathan, as we had on the last slide, is a number that you can call or text him at if you have more questions or specific interest in loan servicing or note fund investment through the Mid-Atlantic Advisory Group. Please feel free to take this last minute or two, everyone, to add any final questions. We're happy to answer them if you still got one that you didn't get a chance to convey over on the question box yet. But as I'm waiting for those to come in, I just want to, again, very, very much a pleasure of mine to have Nathan here and Josh here to provide this education and this information for you all. Really, I'm pretty familiar with lending directly to borrower. I've seen a lot of that in my day as a client account manager, but some of these other strategies that we've went over today are newer for me, and I've learned a lot myself personally as well. So Nathan, thank you so much for coordinating this webinar with me and really bringing a lot of great education and information to the table.
Yeah, absolutely. It was really enjoyable. And for everybody that asked really good questions, thank you so much. And I'm happy to dive into the specifics of those questions more. Just shoot me a text at the number there, and we'll set up a time to chat further. I'm happy to do that with anyone that wants to learn a little bit more, just about doing it on your own, or best practices, or how we can get involved if need be. But even if you want to do it on your own, I'm happy to help any way I can.
And Nathan, are there other ways that our audience can find you guys? Is there, a Facebook page, or do you guys have a YouTube or a LinkedIn page for the Mid-Atlantic Fund or the Mid-Atlantic Advisory Group?
You can go to our website, themidatlanticfund.com. We're also on LinkedIn under the Mid-Atlantic Secured Income Fund. You can find us on LinkedIn, and feel free to follow us. We have a lot of great information that we post 2 or 3 times a week on our LinkedIn page that people find very valuable. So help us get to 3,000 followers. We're almost there.
So, well, I believe I already follow you guys, but I'll go check after here if I don't, and add at least one more to that. Hopefully the audience will kind of help boost that number as well. I don't see any final questions coming in. I do see a few thank yous, and someone posted very, very good. Thank you for your presentation. So I think we've got a hit here. The recording will be on our YouTube page, so anyone can kind of log back in and watch that at your own discretion and at your own pace. But again, thank you so much, Nathan. Thank you, Josh. Appreciate your being here with us, and let's do this again in the future.
Yeah, thanks for having us, Corey.
Of course.
Yeah, thanks a lot, Corey.